Good morning, everyone. Thanks for joining this webinar. We'll be starting here in just a couple of minutes. We're going to let a few more people jump into the chat, and then we will get started. All right, welcome over everyone. Thanks for joining this webinar this morning or afternoon for those of you who are in Europe. Of course, we are talking about potential outcomes following the Trump election victory, specifically on commodity markets. Today, we're going to spend about an hour going through a number of key commodities from oil to metals and grains, talking about how Trump could influence prices moving forward. We will also have a quick macro discussion as well. My name is Reid Ianson. I am head of macro here at Kpler, joined by my colleagues, Alex and Florian, who are cross-commodity experts. They know everything there is to know when it comes to the interaction between commodities and how they price against one another. Again, today we'll be opening with 2 or 3 minutes just looking at kind of our expectations for Trump's macro-focused economic policy, and then I'll hand off to Alex and Flo to dive into specifics around the commodity markets. First, as I mentioned, let's jump into the macro side of things. There are 4 key policy pillars that we foresee as Trump heads into his second stint in the White House. These include aggressive import tariff implementation, namely on Chinese goods, but probably on imports from other countries as well, heavy restrictions on immigration and possible deportations as well, pursuit of continued deficit spending, namely via aggressive tax cuts, which he began in his first term, and challenges to Fed independence. Keep in mind that these 4 factors are inherently inflationary. We've been saying for some time here at Kpler that we are worried about a reinflationary impulse next year, largely driven by the fact that the U.S. economy continues to perform pretty well, and the Fed is cutting rates amid a U.S. economy that is growing at above trend levels. We now inject these additional factors, these Trump policy factors, and we think, again, the risks of inflation next year are absolutely on the table. I'll talk a little bit about that, a little bit more about how the market is pricing that in a moment. I also get a lot of questions from clients around the likelihood that Trump can follow through on these policy objectives. I think tariffs, immigration restrictions, and tax cuts are all going to be on the table, and the administration is going to look to move pretty quickly, the first 100 to 200 days to try and get something done on those issues. It's a bit more of an open question how he might challenge Fed independence. What you'll likely see is Trump takes a pretty aggressive tone of rhetoric when he feels the Fed should be cutting rates. He is also likely to install more dovish members on the FOMC, albeit that is will take a longer amount of time to kind of coalesce as those seats become available. If we look at the market right now, if you just look at this chart to the right, this is the 10-year bond differential, 10-year U.S. government bond differential against when the Fed started cutting rates historically. And you'll notice that we have seen a big rally in the 10-year yield through this cutting cycle. Again, largely indicative of concerns about inflation heading into next year, but also concerns around continue deficit spending. Again, we've really seen that reaction accelerate as the likelihood, heading into the election, as the likelihood of a Trump victory began to increase. And following his win last week, we've really seen 10-year yields start to test that 4.5 to 4.5% level. We were saying in mid to late September, that we absolutely saw a 4.5% 10-year yield on the table. The question is, do they continue to move higher? Again, I think we could at least test 4.6 before the end of the year. Again, as I mentioned, broadly speaking, right now, the U.S. economy continues to perform pretty well, right? GDP is holding above trend. We think the weakness in the labor market was a bit overstated in terms of further weakening, just given the fact that a lot of that unemployment has been driven by a rapid increase in the labor force. Our expectation when it comes to Fed cuts is that they will cut once more in December and likely be forced to pause going into next year. This is quite a change from, say, a month or a month and a half ago, when the market was pricing in at least 100 basis points of cuts next year. And I don't think we're going to see that, just given the tick higher in inflation that we've seen recently, or at least the inflation stickiness that we've seen in this 2.5% to 3% level. And again, we think next year core inflation could get stuck at above 3%, given the factors that I've mentioned. With that being said, that's kind of my quick macro spiel. I will now hand it over to Alex, and he's going to talk a little more macro and then jump into some commodity related discussion.
Thanks a lot, Reed. So based on what you just mentioned and market expectation, actually what happened since Trump has been elected, we saw that there's been a big euphoria, at least in the US stock exchange, the Trump victory, and the increasing likelihood of America becoming a global powerhouse for Bitcoin and cryptocurrency has made the crypto bet the best trade so far since Trump has been elected, as Bitcoin increased by more than 30%. The US dollar as well has strengthened a lot, especially compared to euro and yuan. So there has been a very positive market movement, as I mentioned, US focus, as you can see at the chart at the right side. These also come after a strong Q3 earnings season, where companies reported earnings grew at 8% compared to last year, and that's nearly double of what the analysts had expected. And for next year as well, the expectation has been even more optimistic, with a growth of more than 13%. So that election come on top of very good earnings season we had in Q3 globally, not only oil and gas. Today, the investor exposure to the US stocks is at the highest for the last 10 years. And it's worth mentioning that the Russell 2000, which is usually smaller company, more volatile, rose even more, up by 5%, while the S&P was up 3.5%. That come as the investors are looking to boost year-end performance and probably close the gap with large cap stocks. By sector, the tech stocks had a mixed performance. Of course, at the one hand side, you had the crypto and all Trump associated stock that increased, like as well Tesla. And at the other side, you had some company like Apple that saw decline, driven by fears of potential tariff in China. On the energy stock, so the usual big player and the Shell, they had as well rallied on reduced regulation, expanding drilling under Trump administration, or at least the potential. Banks also performed better, driven by hopes of lighter financial regulation and better economy. So energy stock performed better, while actually oil price decreased during that time. So if we focus on what we want to discuss today on the commodities, as you can see on the next slide, the initial market reaction was not necessarily the one expected. Actually, we didn't see a direct Trump trade on in the commodities. Instead, it has been a trade through currency, so fluctuation on currency and fears on tariff over China and therefore the Chinese economy, that, in our view, really had an impact on commodities. If we compare what happened in 2016, for example, when the first few days after Trump has been elected, the metals market reacted very strongly. We had copper going up by 10% in the first 10 days, and that was driven by expectation of substantial infrastructure spending and a more robust industrial policy under Trump. Aluminium was up at 5%. This year, of the last 7 days or last 10 days, the reaction was different. We had copper and aluminum price that decreased, influenced by concern, as I say, over Chinese economic policy and also by the US dollar. Florian will discuss on the metals a bit later. Same gold price dropped a bit. You can see at the right side on this chart that we had quite a strong move on the natural gas, but that doesn't come necessarily since Trump election. That has been driven by more fundamental of supply and demand. In the US, we had colder weather that started. Supply has decreased from October's high. So we had an increase actually on Monday following weather forecast. Same on Europe for TTF, that has been improving fundamentally. It even decreased more today after OMV mentioned that Russian gas may halt after a recent arbitration with OMV against Gazprom. But the same as Henry Hub, actually, it has been doing better, more due to fundamentals more than the election, at least so far. So that's the first reaction we see. Despite the inflationary policy, as Reed mentioned, commodities haven't emerged as a primary trade. That may come later, and that's what we try to show in the coming slide. But it means also that we will need probably better fundamentals. So if we start with the oil section, I will cover right now. As we mentioned earlier, the market reaction was quite downward. The price went down as the attention quickly came back to fundamentals, which remain weak so far. We expect the refining margin to stay low, at least this quarter, so Q4 and the next quarter as well, Q1. While as well, you know that non-OPEC growth is still expected to rise next year, driven by US, Canada, Brazil, and also China, which are all at the highest so far. This means that if we have any disruption on Iranian production or export, it may be pretty easy to offset. Regarding Trump election, that's of course seen as very supportive for the oil and gas companies, for all the managers, by different potential changes, permitted insurance, removing Biden era executive order, actively making more public lands available for drilling, supporting more offshore, maybe thinking about a pipeline again. But we think that all these potential small things have a limited impact on really increasing physical production level. So far, rigs still remain extremely low. Same go for the drilled, so the DUCs, the drilled and uncompleted wells. A Q3 earnings season also highlighted again that the capital discipline is still strong, especially as earnings for the oil and gas has been the worst for 2 years because of refining margin decrease. So they are really looking to make sure that each barrel is bringing enough margin to continue to allocate nice shareholder remuneration. But we see that efficiency is improving all the time. We have longer and longer laterals. Bottom line for the US, we believe that the price movement will be the key driver actually of production rather than the sentiment, at least in the next 12 months. We expect for next year a growth of almost 0.4 million barrels per day, but that's more than half driven actually by offshore project by Shell and Chevron. If we move to the next slide, which is the second big topic when speaking about Trump election and oil, which is in Iran. So Trump has expressed a strong anti-Iranian sentiment by implementing effective restriction, but that may be more difficult than it was the case in his first terms. So in the face of renewed US sanction, Iranian oil exports have shown resilience the last few months, the last few years, mainly as they were rerouting sales through non-state Chinese refineries. And these refiners, which are particularly in Shandong, capitalize on discount Iranian oil, which is probably around $5 per barrel, and help to boost their margin despite the market challenges, as I had mentioned before. And this setup really benefit to China by reducing actually the cost of their imports, as Iranian and Russian oil drive down price for other crude grades. So given the strategic importance of the oil relationship, China is likely to resist to the US effort to curb Iranian imports. As a reminder, Iran became the largest seaborne crude supplier to China. So Trump will probably have to apply pressure to China to reduce their purchase, but we don't see any significant reduction in Iranian export. And it will likely probably take at least 5 to 7 months to materialize, as economic and diplomatic complexity in persuading independent Chinese refiners will take time. So by mid-2025, we might see a reduction in Iranian oil export by around 500,000 to 600 kbd through, depending how Chinese resistance is coming. Additionally, keep in mind that Iran has outlined a plan to boost its production by 250 kbd potentially, helping to offset their older field. Of course, we know that if that oil, that 500,000 barrels per day decrease, it could be replaced as what you can see here on the slide. You have two sanctioned countries, so Venezuela and Russia. They could offset a third of the 500,000 barrels that could be lost. But we have a lot and much more actually on the non-sanctioned. Saudi, Kuwait, and United Arab Emirates, more than doubled of what will be needed. Same for West Africa, US, as we mentioned, but as well Canada. Just mentioning, there is even a much greater impact on the methanol and LPG, as Iran is China's largest provider for methanol and the second largest for LPG. So if we try to see on next slide what the impact could be in terms of prices, we see potentially on Trump election at $2-3 per barrel upside in the medium term, so mid 2025, as it fits with what we're seeing on Iran, so down by a million barrels per day. But there is, of course, a limited upside above 80. Of course, Trump, if there is a loss in terms of production and exports in Iran, he will push OPEC Plus to compensate for lower Iranian export. We know that the spare capacity is almost at the highest for years. OPEC has 5.6 they could bring back. And in the longer term, if we can call it a longer term, 2026, it's slightly bearish because we think that there is a slight impact on US production. So not next year, but in 2026. The key question mark is, will the economic boost be stronger on the demand than what that can be bring on the supply? But it's not only about US production, but maybe also easing some of the Russian sanction, and maybe see if there is potential changes on the infrastructures with a Keystone XL. Moving to the next slide, so the final one on regarding crude, just to re-highlight that for next year we see an average oil prices, so Brent at 75 per barrel for all the reason we mentioned before, with a bottom in March at around 73. We highlighted here as well the positioning on the market, but that was a positioning before Trump election on CFTC. So it's still low historically, but if we look over the last 52 weeks, we are average net length. We probably are more bearish when it comes to the CTA. That's probably the positioning has been probably much weaker with the recent price decrease, and we'll wait till Friday to see what's going on the positioning from the CFTC. Now I'll hand over to Florian. He will cover nat gas and as well metals.
Hello, welcome. Thank you, Alex. Yes, so we move over to nat gas and LNG. So as Alex already mentioned, the US president holds much greater influence on infrastructure projects such as pipelines, terminals, rather than actual supply levels. Still, during Trump's campaign, the word US energy independence was mentioned very often. And even more, Trump specifically said he would use energy to leverage the US around the world. Now, regarding LNG, the US already is the largest LNG exporter in the world. It overtook Australia last year. And we do expect swift approval of additional projects in future. Specifically, the Department of Energy paused non-FTA permits. That's very relevant because permits to countries that have a free trade agreement with the US in the past were a matter of months, whereas non-FTA permits used to take many years to get approved. Overall, the pipeline of projects is massive, and we expected up to 124 million tons of projects on an annual basis could be accelerated, be it either via a non-FTA permit or a simple extension. At the same time, US natural gas supply it's definitely supported by Trump, but as we mentioned, we think that US upstream players are more focused on the pricing dynamics, and that the US president himself has relatively little impact on the supply levels. It's a similar story with nat gas demand. Also there we see that the upside potential to US demand is relatively small. As we will mention later on, the slowdown in renewables and also the reduction in incentives from the Inflation Reduction Act, in our view, will be less than generally expected right now. Secondly, the share of natural gas of US power generation is already very, very high. So last year it was above 43%. And that's just for comparison, in the EU, we stand at 17%. So there is a natural limit to that. And also it was mentioning that the requirements for clean power generation is mostly on a state level and not on a federal level. So here our main message for this part, yes, Trump will accelerate the permitting of LNG export facilities, but he will have a limited direct impact on domestic supply and demand. If we move to the next slide, please. So what does this mean for nat gas prices? Overall, we expect it's bullish for Henry Hub, mainly because there will be new LNG export demand. However, the impact will be moderately bullish. Bear in mind that right now, US LNG accounts for less than 12% of US total natural gas supply. So even if this share goes up in future, it is still not the main driver. The main driver will be domestic US demand dynamics. Aside from new LNG export capacity, there's also expectations of a stronger US economy, of course. The so-called deglobalization, we expect there will be more manufacturing activity coming back to the US in future, which is of course supportive for domestic natural gas demand. So long-term outlook, mildly bullish, short to medium term, still relatively muted. We have still very high stock levels, something that has dragged along the whole year after last winter. US stocks ended at very high levels. The heating season has so far seen a very slow start. And there's also a lot of withheld production capacity among US upstream players. So all of that limits the price upside. And in our view, Henry Hub will peak at around $3.25 per MMBTU in January and bottom out at around 2.35 in May 25. Again, main message here, yes, Trump is bullish for Henry Hub, but only moderately, mainly because US LNG accounts for a minor part of the total demand in the US. Next slide, please. Now we move over to metals. So what does Trump mean for US copper demand? As Alex already mentioned, contrary to 8 years ago when Trump was elected for the first time, this time base metals dropped strongly. And this was mainly driven by expectations of a slowdown in renewables capacity. Also expectations that tariffs will curb Chinese industrial output. Again, the broader Chinese economic weakness. So last week we had this latest data point, a dip in new lending activity, and eventually also the stronger dollar is also weighing on the whole base metals complex. Now, of course, the climate change skepticism in Trump's administration could mean lower public spending on energy transition and less copper demand. However, it's worth bearing in mind that between 2026 and 2020, during Trump's first term, investment into wind and solar actually accelerated. Overall, US wind power capacity went up by more than 50%. Of course, this was driven by markets, by falling prices per capacity, but nevertheless, Trump certainly did not hinder this development. Now, we have often been asked in recent days, do we think that Trump will repeal the Inflation Reduction Act, which is this landmark piece of legislation supporting US renewables? We think it's highly unlikely that this will take place. The first reason is most of the IRA investment actually took place in Republican states, and also the majority of the IRA-related jobs that were created were in congressional districts led by the Republicans. Secondly, or maybe also worth mentioning, like just some examples, like we saw new battery plants in Georgia, in Alabama, in North Carolina. We saw solar manufacturing facilities that started. We saw a lithium refining facility in Texas. So there is heavy investment driven by the IRA in Republican US states. Second main reason why we think that a repeal of the IRA is unlikely, in our view, the IRA is by now a net benefit to oil firms. They have focused on specific parts of the IRA, mainly carbon capture and storage and clean hydrogen. And also there are interesting things that the IRA stipulates, for example, that at least 60 million acres of offshore public land need to be made available for oil and gas exploration every year. Otherwise, this would hinder the issuance of wind power development offshore. A similar story with EVs. An end of subsidies is very unlikely. The Trump-Musk alliance that emerged over the past months, of course, speaks against that. And also it seems that Trump is not against EVs per se, but rather against banning gasoline cars. One major change, however, that we expect is that under the new head of the EPA, Lee Zeldin, we will very, very likely see a moderation of the EV mandate. This is a piece of legislation that requires manufacturers of cars to reduce emissions from new cars by 44% by 2032, compared to, I think, 26 levels. And that's a piece of legislation that Trump outright called ridiculous. So that's very likely to be moderated. Other aspects that are interesting, yes, we will not see a corporate tax hike under Trump. This will have a big impact on renewables project. It will keep the economic viability of many projects intact. And the only, let's say, fine line Trump will have to walk is the renewables fuel standard, where, like in the past, this is a standoff between oil refiners and ethanol producers in the Midwest. Overall, main message here, yes, we don't think that the IRA will be repealed, mainly because it benefits Republican states, oil firms, it created jobs. However, a moderation of the EV mandate is very likely. Moving to the next slide, where we dive into the implications for renewables and copper demand in China. Yes, the fiscal stimulus that China has announced over the past months, they have disappointed by and large, and they have also more been targeted towards manufacturing and not towards the more copper-intensive sectors such as property. And at the same time, our ship tracking data shows that Chinese copper concentrate imports have been very, very strong this year. And copper cathode production, like the actual smelting of copper in China, had even been at record levels for every month this year, except for September. Now, how is it possible? Like China has a weak construction sector, but what buffers this is the massive expansion that China has in renewables capacity. So we expect that this year, Chinese new wind and solar capacity will even exceed the additions from last year, which dampens the impact from low construction activity. And also so far, up until September, Chinese exports of copper products have been very strong. However, this is something that will change or has already changed, because since late September, there are US tariffs on various copper-intensive goods, ranging from EVs to solar cells and batteries. So our main message here, yes, Chinese copper demand is under pressure, but the renewables expansion in China continues despite the economic woes and will limit the downside to Chinese copper demand. In the next slide, please, we want to see how does the development in copper compare to aluminium. Our main theory here is that all other things being equal, Trump tariffs will have a greater impact on the aluminium market than the copper market. That's mainly for two reasons. First, the US import dependence on aluminium is even greater than when it comes to copper. And secondly, also China's dominance in the aluminium sector even exceeds its role in copper. China is already the third largest supplier of aluminium to the US, even though in this regard, it's worth mentioning that China is still well behind Canada, the #1 supplier. Overall, these tariffs would therefore strengthen US copper prices relative to US aluminium, tariffs will strengthen US aluminium prices relative to copper, and this would weaken the copper ratio to aluminium further. We've seen this trend already over the past quarter, that aluminium has outperformed copper, and there are additional fundamentals supporting that, mainly the export constraints in Guinea, which is the world's largest exporter of bauxite, and also the renewed promotion of using more aluminium instead of copper. Aluminium is for a few applications such as transmission lines, aluminium is one of the few feasible alternatives to copper. In the next slide, we briefly touch upon gold. In the longer term, yes, we do expect another boost to gold prices, especially if geopolitical tensions continue to rise. And also, as Reed mentioned in the beginning, because of structurally higher inflation expectations and inflation levels. However, for now, we do see pressure on gold, mainly due to the reduction in rate cut expectations next year and a stronger dollar. So again, long term, the inflationary policies of Trump will be bullish for gold. However, in the short term, we do see some downside. Now we move to our last chapter, grains. Now the overall market reaction to the Trump election in grains has been relatively muted. However, there are some major dynamics that could emerge. Now, the US is already, alongside Brazil, the main player on the global market. The US accounts for 20% of global corn exports and 25% of global seaborne soybean exports. And at the same time, China, of course, is the main buyer globally. But as you can see in the chart on the right-hand side, our data shows that Chinese buying has shifted a lot in recent years away from the US towards Brazil. And also more recently, this year, we can observe that Chinese soybean stocks are rising strongly, very likely in anticipation of a trade war with the Trump administration. Now, you can see in the chart that in terms of relative and absolute volumes, the impact that tariffs would have, like Chinese tariffs on US volumes, would be much greater on soybeans than on corn. And at the same, so meaning it's a stronger bearish impact on soybeans compared to US corn. And this is also supported by the domestic use cases in the US. So corn has a massive use case for ethanol. The renewable fuel standard requires significant amounts of ethanol to be blended into the gasoline pool. So this is also a welcome outlet for domestic production of corn. However, should this trade war unfold between the US and China, we see a dynamic strongly impacting US soybeans. So in recent years, the biodiesel market in the US shifted to cheaper feedstocks from abroad. That's mainly used cooking oil from China or tallow from Brazil. And so should the US put tariffs on these Chinese biodiesel feedstocks, and at the same time, China buys less soybeans from the US, of course, the US biodiesel industry will connect the dots and say, okay, let's use the soybeans that China is not buying anymore. Let's use it domestically to replace the used cooking oil and other biodiesel feedstocks that we used to buy from China. So what we can likely expect is that the soybean crushing capacity, which is deployed to turn soybeans into soybean oil, this will likely rise in the next coming years. To the next slide, please. So if you look at on the right-hand side, you see the soybean corn ratio. That's a very important metric because these two agricultural products are the main products where every year it's decided how much acreage should be planted with this one or the other one. So this ratio has weakened a lot over the past 4 months. And however, we expect this to stop because soybeans will see support from other sources. We see a strong uptick in non-Chinese export demand for US soybeans. Secondly, what I mentioned before, US soybean crushing capacity will likely increase should a trade war with China unfold. And at the same time, the market for palm oil is very tight. Prices have been rising to record levels in recent months. And also this is strongly supportive of soybean oil. So overall, our main message here is, yes, a China-US trade war has a greater impact on US soybeans than on corn, but should the US stop importing Chinese biodiesel feedstocks, then there will be new US soybean crushing capacity, which will support soybeans relative to corn. So that's our last remarks on this type of commodity, and we thank you for your attention and look forward to hearing your questions.
All right. Thanks for that, Florian and Alex. We are now going to have about 10 minutes for Q&A. So if you guys have questions, just go ahead and click the panel at the bottom or top of your screen. Go ahead and send those questions in. We'll be happy to answer them. We're going to start, Alex, with you. It looks like we have a question on, the relationship to Trump's first presidency. Back in 2016, Trump had a significant impact on the U.S. oil and gas industry, obviously. Why would it be different today?
So I think the context 8 years ago was a bit different because we came from a real rebound, or we had a big collapse on oil prices going from 100 to 50 in 2015. So we were already a bit in a recovery mode. It was the first election of Trump, so from a business point of view was very good. And a big difference compared to right now is that a lot have been small, mid-sized player, which is no longer the case right now in terms of players, because there has been a big consolidation. So that's the first thing, big difference. No longer small players are big players, so maybe a little bit less sensitive. The oil context is not the same, and I will say the last is probably that capital discipline came a bit later, came in 2017, 2018. So at that time, oil companies in the first election of Trump were still looking to really increase production, so more driven by volumes more than margin. So that's why it's different. The context was different. I think capital discipline and big player is the big difference.
Awesome. Thanks for that, Alex. And actually, just to build on that, we are getting a question on, what's your view around Trump's strategy for the SPR? And, could it deviate a lot from what we've seen during the Biden administration?
So we know that the capacity has been decreasing. So I assume that he will probably more try to manage the OPEC guys to bring back production, because there is a lot of spare capacity rather than using them. But probably if oil prices go below or lower than the current level, he for sure will probably take the benefit to buy. But I cannot imagine so far that with the spare capacity available from the OPEC that they would release more oil to the market if oil prices go up.
And just to kind of add to that as well, Alex, I think it's a big open question. Would Trump aggressively look to refill the SPR? It seems like an unlikely reality at this time, but it's certainly something to keep an eye on, because I think there is a big question, especially given some rhetoric we saw on the campaign trail about, Biden's big drawdown on the SPR. Would Trump look to reverse that policy? Again, not a lot of indications that he would do so at this point, though. Florian, I'm going to shift to you next. We're getting a question, regardless of the price and sentiment impacts that are mostly on the financial side, do you see any major impact on the physical copper trade flow that's currently taking place?
Now, most of the copper concentrate that the US imports is from Chile, Peru, but these volumes are very, very small. So the contrary to aluminium bauxite, the US has a very large domestic copper mining industry. So in terms of physical flows, I think the main impact will be that the tariffs on Chinese products containing copper will be impacted. The physical flows of like the stage before these products are being manufactured, I think there will be relatively little impact from that. Mainly because even now these flows are relatively small. If something, it will be the manufactured goods that are impacted. As said, and these tariffs are already in place since late September. So EVs, okay, that's not really relevant. The share of Chinese EVs in the US is very small. But of course, batteries and solar equipment, this could be impacted even more strongly.
And to kind of build on that, do you think that the decline in copper prices that we've seen could sustainably continue over the next year? Do we think we'll see a reversal? What do you think?
Well, Chinese like copper prices rise and fall with the outlook on China. Of course, the tariffs that Trump will likely implement will hurt China. However, the long-term fundamentals, in my view, are still decidedly bullish. So we have this plethora of use cases in the energy transition where there's no feasible alternative. I mentioned aluminium, but that's for a very narrow range of applications. And at the same time, the copper mining pipeline is very limited. Plus, these mines are located in, let's say, not in the most politically stable countries. So I think long-term prices should definitely rise. I don't see that prices would stay at these levels for a year or longer.
Awesome. Thanks, Florian. We have, and actually, I did not mention at the outset of this presentation, we also have Hamayoun on the line. He is our Iran and Middle East expert. So we're going to go ahead and throw a question to him on Iran. It looks like if Iran is forced to decrease its oil production, how long would it take for them to restart it? And how quickly do you think OPEC would respond as well if you were to have Iranian barrels coming off the market?
Hey, thanks, Reed, and hi, everyone. The question on how long will it take for Iran to bring back the barrels, I guess will mostly be linked to the relationship between the US and China. So as Alex mentioned during the presentation, the key here for the Trump administration in order to hit Iranian exports again is to convince China, and as we know, it's mainly the non-state refineries which are buying Iranian crude. So it's to push Beijing to itself, in turn, push some of these private refineries out of the business with Iran. And so we think to an extent it will become successful, but not by that much. So as Alex said, we expect a decrease of 500,000 barrels per day by the middle of next year. But then how quickly it will come back will also be a function of that. And then I think the rest of the question you mentioned about OPEC Plus offsetting that lost supply from Iran. As Alex said again, we have very high spare capacity within OPEC Plus, more than 5 million barrels per day now, mainly in Saudi and the UAE. So these two countries, it's about 90% of that spare capacity. The question is, I think these countries will also need to be extremely careful if they are to replace that shortfall, given heightened regional tensions and the risk of an Iranian backlash if they're perceived as a kind of exploiting the situation. So their relationship with Iran has improved over the past few years. They'll probably be extremely cautious. So we could see maybe more barrels physically on the market, but any announcement will have to be extremely carefully phrased so that they avoid provoking a potential Iranian attack on their own infrastructure.
Awesome. Thanks for that, Hamayoun. Let's just take maybe one more question here. We're at about the 10-minute mark. We're getting another question on China, specifically around what are and I'll go ahead and take this one. What are your expectations on Chinese steel exports after the election? I think in general right now, and kind of as I mentioned at the outset of this presentation, that Trump would look to aggressively implement import tariffs on Chinese goods. Keep in mind that this is not just a US story. Countries across the world are implementing tariffs on Chinese goods to protect their domestic industries. If you look at Canada, Mexico, Chile, Brazil, India, obviously the European Union, all implementing import tariffs. And in places like Brazil and India in particular, they're really starting to ratchet up tariff implementation on Chinese steel exports. So I think it is just a matter of time before Chinese steel product exports start to really come under pressure. They've obviously accelerated a lot, but I think as these tariffs start to really bite, those export levels will come under pressure. And I think this narrative is true across a lot of Chinese exported products, from EVs to batteries and other things as well. Steel is just a part of this broader trade imbalances story that we're currently seeing in China right now. Let's take one other question here. We're getting a lot of questions coming in here. Maybe Florian, we'll come back to you. What impact do where do you see European gas prices going, specifically over the short to medium term? Do you think it could be inflationary? Do you think things are going to be okay? Kind of just what's your broad view on European gas?
Well, if we stay with like the Trump impact, well, I would say it's Trump is bearish for European prices. First of all, the obvious ramification is higher US LNG availability. Secondly, the greater chance of a potential easing in US sanctions versus Russia. So this could reshuffle the global natural gas trade, because bear in mind, with crude, Russia managed to completely shift to new buyers. However, with natural gas, this didn't happen because Russia is lacking the LNG export capacity. And also, as we saw with Arctic LNG 2, even if they export something, they're struggling strongly to find buyers, because most, even in the developing world that are very price sensitive, even there in the terminals, it's mostly Western majors behind these terminals. So meaning these terminals would never buy or dare to buy a Russian cargo. So easing of sanctions towards Russia could also be bearish for not only European but global gas prices. And also the outlook on US on the corporate US system with like lower taxes or the continuation of low taxes paired with higher European energy prices could see a shift of manufacturing from Europe to the US, which again would weaken European demand and weaken TTF prices.
Awesome. Thanks for that, Florian. All right, everyone. With that, we're at about the 12-minute mark, so we're going to cut it there. Again, thanks everyone for joining. We're going to come with further updates, especially when regarding the Trump administration, as we get more information coming through into next year. But again, thanks for joining this webinar. We'll see you again next time.